Morning, everyone. By way of brief introduction, my name is Matthew Seah. I'm a partner with the Maritime Trade and Offshore Finance team of Stephenson Harwood here in Singapore. And it's my great pleasure to introduce today's panel. We've got Khalid Hashim, Managing Director of Pressure Shipping, Torbjørn Gjervik, Chief Executive Officer, Western Bulk, Stian Hallan, General Manager, Union Bulk Singapore Branch, Sung Yong Do, Managing Director and Head of Chartering at DryDel Shipping, and Edward Buttery, Chief Executive Officer at Taylor Maritime Investments. I'm happy to introduce today's topic. Dry bulk is positioned well on the supply side. More challenges abound on the demand side, but for shipping, such negatives are often a positive, and which investment strategy suits best for dry bulk in 2024. I don't propose to stray too far from these three pillars of supply, demand, and strategy. And over the next half hour or so, hopefully, we'll look to tap into the knowledge and expertise of our panel to kind of get a snapshot into the market, and as well as their views on strategy going forward based on where we stand today. So I suppose, if starting on the question of supply, conventional wisdom is that the new build order book is low for dry bulk. We've got an aging fleet that's due to, retirements will have to happen soon, or vessels will have to start sailing at slower speeds. So everything is rosy on the supply side. But I wanted to, as an introductory question, get our panel's views on the order book, on the supply situation, and whether they see any kind of caveats or nuances to this conventional viewpoint. Maybe if we start with Edward at the end and work our way down the panel.
Morning, thanks. Yeah. Supply, well, so we've got clarity on the future supply of geared bulkers and all bulkers. Obviously, yards are filled with lots of different segments of new buildings. So we've got clarity on supply. Capacity is the sort of wild card that could or may not change, but it's unlikely to change the way it did in the 2000s. So yeah, the supply side is attractive. Demand is looking pretty resilient, actually, going forwards, and it always has been in dry bulk, certainly on the geared sector. But prices are high, historically speaking. So how much upside is there relative to your downside? And the answer to that question is relative. Comes from where you entered in your investments. So at the moment, Taylor, we're exiting ships. We exited 19 last year. We've done over 10 this year. We're taking profit. Nobody got poor taking profit. But we're still going to be net long. And the question is having the right types of ships. Khalid has some new ships coming, and you guys know what I'm talking about. The quality of the ships you have is going to be the most important thing. Appealing to your charterers, efficient. So my strategy, 24, 25, net long, but take profit when it's there.
SY?
Now actually very low the order book in historically low at the moment, and then now it's around 2028. It's all occupied shipyard. So also many uncertainty for the regulation, and then pure metal, everything is uncertain. So I think one point is demand and supply is break, balance is break. Then market maybe. Some point is the market is very, the volatility is very upside, I think. But the problem is the last few years we very aggressively expand our fleet. But at the moment it's the very high price, and we competing with another segment like LNG, container, car carrier. So very difficult we can occupy. We are get the slot. So I think next few years is very the demand is very short in the dry bulk. So I think all depend on the supply is very short. So I think it's more important is demand, but China economics should be the recover next few years. So also yesterday some report China announced the economic stimulus. So I think it's the next year's shipping market should be positive. So our strategy is supply side is actually now at the moment difficult to be the new building. So now we try more focus for second hand at the moment. So second hand eco vessel, like it's less than 5 years. Our strategy like that. Yeah.
Stian, do you have any thoughts on the?
Well, I think just to echo SY, and we are a smaller operator than the guys here, but our strategy has been the same. I mean, the prices have been very high. We have put a lot of ships back to the head owners because it doesn't make financial sense to run them in the market. Spot versus period has been very large. So right now, I think, like SY said, the demand is everything. I mean, the supply looks like we're not going to have a lot of supply in the next coming years. So it all depends on demand, and I think demand looks fairly healthy. It's been fairly weak, but also so has the supply side. So the markets remain fairly balanced. So hopefully now with the new stimulus in China, they will pick up a bit more there because they are basically the driver of dry bulk, and it's exciting to see. I'm bullish for the next few years. So you know, any good period deal is out there, we'll look to take it. Yes.
Maybe Torbjørn, if you just work through the panel on this question of supply, and then we'll be bit more selective when we talk about demand and other aspects.
Just to try to add a little bit of flavor from Western Bulk's perspective, as we see, though, we're a little bit more neutral on the supply side than some of the owners here. We think there's a growing order book on Supra and Panamax. We see also vessels remaining in the world's fleet trading longer in dirty sanctioned trades. And the scrapping might get delayed longer than normal. We see a Panama Canal that is reopening, so to speak. More vessels flowing through there. What's going to happen in Suez in 1, 2, 3, 4 years? That's going to have a negative effect on the market as well. So we definitely don't think everything is rosy on the supply side. So we are keeping a neutral outlook as such. We are, though, very interested in diversifying into ship owning at some point, and we are here to explore that further. And the entry point will be very, very important. So, that's it.
Thank you very much. And finally, Khalid.
Yeah, for pressure shipping, we have a strategy to try and sell off our older ships, and just as Ed has been doing, and at the same time to replace them with, say, 9, 10-year-old, little larger handy sizes. And if we can, place some orders for new buildings on the Ultramax side, which is what we have done. On the speakers that have been there before us on the last panel, they were discussing about so many things in terms of the green transition in fuel. When we approached our shipbuilder and asked him that what would be the price differential between an Ultramax new building burning low sulfur fuel oil and something that could have an alternate flavor like ammonia, LNG, methanol, whatever. And he said that, yes, we could try and do that for you. The price differential would be somewhere between, say, the $33 to $35 million, which you can get for a new build today, and $45 to $47 million for a alternate fueled engine. But he says the engines will only be available in 28 or 29, as against which he can give you a fuel-burning ship by 26. So the choices are very limited. Secondly, for the type of trade that we are in the geared ships, we are a pure tramp operator in that sense that our ships just go where the cargo takes us. And you need to have fuel there. If you don't have the alternate fuel there, you might as well be burning fuel oil. So looking at all of those factors, despite the fact that the second-hand prices are high, if we sell an older ship, we do benefit from that, and we can replace it with a 10-year, 9-year-old, 8-year-old ship, which is a larger deadweight ship, which will give us a much lower grams of CO2 per ton mile of cargo carried. So that's been our strategy to follow on the supply side.
Super, thank you very much. Then moving on to the question of demand, I suppose, when you think about demand in dry bulk, you have to think about China as one of the key factors in dictating the strength of the bulker market. I think we've seen some resilience in the Chinese market this year. Coal and steel imports have been strong, but interesting to get the panel's view on the situation in China, considering the situation with the real estate market there. The incentive programs that have gone in. Will they work in the long run? So maybe we start with Khalid. Your views on China and dry bulk.
Sure. So on China, Clarkson's just recently had a nice report out. They said that before 2020, China's demand would drive commodity prices. But since 2020, everything has changed. Like during 2020, COVID hit the world hard. So the rest of the world's demand for commodities dropped dramatically. Prices of commodities dropped as a result. China went and increased their demand by 9% that year, overall in terms of dry bulk imports. Of course, 2022, we had the Russian war in Ukraine. As a result, commodity prices soared. That's what normally happens, and you could see that in the last presentation that was made with all the blue lines spiking up in 2022. And so China didn't increase their purchases at all. But since the middle of 2023, continuing up to today, prices have dropped of all commodities by 34%. As a result, China's imports starting out in June 2023 and continuing till today has gone up dramatically. Between June of last year and June of this year, they imported 3.05 billion tons of commodity. It's not a joke. And I got the latest numbers, which I'm going to try and read out from this cheat sheet of mine, to give you what has been the first 8 months of imports into China compared to last year. And then I want you to remember, this is against the backdrop of the entire Western media stating that China has collapsed and everything is going wrong with that country. So here goes. Iron ore, up to the end of August, 816 million metric tons, up 5.1%. Coal, 342 million metric tons, up 11.8%. If they continue at this rate, they'll have a record-breaking import of more than 500 million metric tons in a single calendar year. It's never been done before by any country in the world. Bauxite, 108 million metric tons, up 11.7%. The only negative number that I have is coming now. Soybeans, 70.5 million metric tons, down by a gigantic 1.7%. Grains, 40 million metric tons, up by 17.4%. And sugar, it's a small quantity, but it's an impressive increase in percentage terms, 2.5 million metric tons up to the first 8 months, up 57.6%. So if these numbers are real, and we can say that they are because we carry some of these cargoes, you can clearly see that China has not underperformed in any way. And their buying of commodities today is more linked to the price of the commodity than in terms of what's the demand at home.
Torbjørn, did you take the same view?
Yeah, I think very interesting, Khalid. I think we have the same view that we're definitely not writing off China. They're going to continue to grow, eat, live, and develop. That being said, though, add a little bit of flavor again to it is a different view on I think there has been some front loading here. I think they have been taking advantage of lower commodity prices and spend the first part of this year stocking up. There's higher stocks in that country at the moment for most commodities. So some uncertainty there. What's also a bit perspective from an operator to see is that what it does to the trade flow. We see that steels is being exported from China, record backhaul rates going into the Atlantic. less soybeans coming out of US for China. What does that do to the overall market? That means for us as an operator, we have a flat market overall on the index, hovering around 14,000 for many, many, many months, 14, 15,000. But at the same time, you also have a relatively flat basin spread. So it's a very tough environment for an operator to make money in this market right now, because you have a flat index, but you also have a relatively low difference between the two basins, so you can't take too much advantage of that. So you have to stay extra sharp and be extra on the ball in order to be successful.
Cheers.
Yeah, just to add on that, I think what Khalid said, I mean, China, they're obviously extremely smart, so take advantage of low prices, massive stockpiles. They've been producing, continuing to ask their steel producers to continue to pump out steel, even though the domestic demand is low and weak, ergo all the exports, right? But I think to Torbjørn's point as well, I mean, if you have a steel loader, you can move the ship back to Atlantic, but what are you going to get when you get there? I mean, that market has been absolutely rubbish for whatever, 6, 12 months. Is that going to change? I don't know. European demand has been weak, so, you know, there's no point to take a ship at 15,000, send her back at 15,000, and then you face 8,000 in the Med. So we will see, but I think China is always going to be the main driver. They are the biggest country. Even 3% growth is going to be, you know, 10 times any other growth. So it will be continuing to see the progress there, yeah.
And then maybe, you know, we can still keep talking about China on the demand side, but kind of balanced against taking maybe a conservative view, you know, mindful of the position of China, maybe for our final two panelists, you know, are there any other emerging commodities or new markets that you're also looking at kind of as a hedge or as a natural balance, depending on where the kind of traditional markets go in the next few years?
As a natural hedge, other segments? No, I'm just taking profit and putting it in the bank. I mean, we all know everything's expensive. No, the hedge for me is paying off debt. We're at 20% loan to value on $500+ million of assets at the moment, and that number will get smaller. And as I said, net long. So, you know, I plan on having a few easier years compared to my previous few years, and sleeping better at night with less debt and some dividends coming in.
SY?
Okay.
Sorry. The question, it was just, you know, mindful of the situation in China, are there any other markets or any other commodities, you know, that you're looking at or that are of interest to you?
Actually, now is actually the South Asia is getting emerging. So a lot of coal going into Vietnam as well, is power plant. So alternative commodity, except iron ore, coal, then maybe we around this nickel or the biofuel, something agricultural residue for biofuel or biomass for renewable energy. But this one is the problem is this is not big segment commodity. This one the minor side like handy or ultra side. So still I looking for what commodity the change for capsize, but this is kind of should be the short term should be driving bulk market by coal or iron ore or grain business, but come close to long term to change to bio sector like or the electronic car sector.
I also saw, I think Goa, West Coast India now have opened up again for iron ore exports, right? That's been banned, closed for 5 years, which was a major driver out of the Indian Ocean. And that obviously will fuel that market a little bit. It's been quite depressed for some time. Also Indonesia with the bauxite allowing some exports again. Obviously moving a little bit away from everyone needs to build a smelter because they basically can't, right? So the nickel and bauxite exports is something that's also going to help the Southeast Asia market. So,
yeah, just 2 points. One is disruption. There's just an article out yesterday Clarkson's research is saying that the disruption in the Red Sea has increased cargo demand by 3% already, which is more than the cargo demand for last year. So just this one factor has pushed demand up by 3%. So this is just one example of a disruption. The other one is, of course, climate change. And I can just give you some anecdotal evidence from our ship's masters when they report back to us. They say that nowadays, when you're doing a trans-Pacific or a transatlantic journey, you have a few days of good weather. The rest of the days are bad weather. And the bad weather days are getting much more intense. Like to get 10-meter waves in a bad storm is very normal today, which was quite unusual for seafarers in the past. Of course, this is slowing down all the ships. Nobody's looking at this or calculating. This is another disruption taking place at sea, and the same disruption is taking place on land, where either grain cargoes are being destroyed in countries that were producing grain. Now they need to import grain. And similarly, when ships arrive at a port, if there's bad weather and you've got a sensitive cargo, you can't discharge it. You just got to wait. So congestion is building up everywhere in the world thanks to the climate change that has taken place. So these are just the two examples of disruption. Of course, from climate change, you see the Amazon, the northern part of Brazil. There is no water at all, and therefore no cargo movement taking place from there. And the southern part, there is enough water, so you have a lot of grain, but then you have lots of ships queuing up there to try and load it because there's no support from the northern side.
Super, thank you. I suppose then, if we move on to the kind of third theme of today's panel and kind of strategy and where we go forward, maybe we're starting with the sort of the owners on the panel, looking at the longer-term question or medium to longer-term question of fleet renewal and expansion. You know, given current new build prices, yard capacity, you know, are we? I think we touched on it earlier in some of the responses, but is it too early to be talking about new build ships in dry bulk? And to the extent you are looking at new builds, you know, are they specific sizes or specific segments of the market? Maybe we start with SY.
Yes, now the almost occupied 2028. So now last few years we around 10 vessels you bidding until 2028, but now price increased a lot. So because it's another segment like container or LNG. So now we are more focused to the second-hand vessel at the moment. We are balanced because now very uncertainty for the alternative fuel or something. So we are more focused for, if you building, then more focused for eco style, the new hull design and the fuel saving device or something. This one make it around, we think, 25% reduced emissions. So at the moment we are like a bit stopped to new building order in the market. So we just more focus for second-hand vessel or eco type vessels.
Thank you. Edward, any views?
I think you can make a good argument you can make a good mathematical argument for ordering a new building now, but I personally wouldn't, purely on the basis of saving 5 or 6 tons a day at $600-700 a ton for fuel oil, because your payback on that is very fast. But you're paying $38-39 million for an Ultramax in Japan, and maybe 34 on a good day in China for delivery in 28. So you're putting down your 10-20%, whatever it might be, and it's sitting there doing nothing for 4 years. That's not a great use of capital. So the 10-year-old argument is a valid one. The ships have taken a lot of depreciation, and we all know that the, relatively speaking, small investments you can make in paints and boss fin caps and other energy-saving devices makes quite a significant combined reduction in your emissions and improves efficiency considerably. If you've got a fleet of 20 to 40 ships, that's a lot of money. So, you know, if I was buying ships today, I would also be looking at 10, even in some cases, maybe 15-year-old high-quality ships from high-quality owners who you know have maintained the ships well previously.
And then maybe our last owner on the panel, Khalid, do you have any views on kind of, new build versus second-hand
Yeah, so we're at least on this panel, we're the only one who's ordered some new buildings. We've got 4 of them in China coming in on the Ultramax sector. And as I said, we've asked them for many things. We've asked them to try and make it dual fuel, but the cost is prohibitive, and then they don't have the engines. And the engines will only come in 2028 or 2029. So, we are hedging in the sense that we are looking at a longer term play and saying that an Ultramax will eventually hold its own against any other ship in the geared sector. Therefore, if we can, we should be disposing of our smaller ships in the Ultra sector, which is the Supermaxes that we have. We should get rid of them at a profitable level, because today people are just crazy. They're just paying silly money for older ships. And it's good to exit that and replace it with a younger ship. But again, it's just 4 ships that we've ordered in the past. If we had to order the way we had done in the past, it would have been at least a dozen ships, not just 4. So again, it's a small play just to make sure that we have enough skin in the game as time goes by, and we have the right quality of ships with us. And then otherwise, second-hand, 9-10 years old, which are good, well-maintained ships.
And then maybe to our 2 more traditional operators, Torbjørn, you mentioned you're looking at maybe going to ownership. I know, Stian, you've bought your first ship. Sort of, in terms of strategy, where are you investing your resources and your focus? Is it a case of operational efficiencies, systems, or are you looking at more drastic, changes or into diversification into other segments of shipping, or more widely into ownership? So maybe if you can give us the operator's view on strategy in 2024.
I think for us, being a smaller company, it's all about personnel. We're very flat hierarchies, lean, and it's about having the right people, both on the commercial and operations side. Like you said, we did purchase a vessel last year. That was in Buttery 28. We had a purchase option on, and she's been with us for 3 years on period. And of course, that purchase option made sense last year, so we took that. We were planning to flip her, but the value of having an asset in a small company is tremendous. So now we've gone about and proper financing and technical and all that. So we will run her in the market, and as it looks right now, she's still running very profitably. So that's been a good deal for us. But strategically, again, we've been a pure operator for 5 years, and we will probably remain so, obviously with one asset, but then there will be another 10, 12, 15 TC in vessels, so which we're tramping around, obviously worldwide. So I think, again, for us, it's personnel. It's having the right people,
No, I agree with Stian that and your asset light, your assets are your people. So that's the most important thing. I think in general it comes down to people, the culture you have in the company, the systems, and the brand, and the cash and the cost. These are the things that at least in Western Bulk I will be working on to make sure we are the best we can be on this. When it comes to the systems, playing more and more important role. When it comes to optimization, we have a fuel optimization team that is working on with the owners to try to get the most out of the vessel, and also prefixing to select the right vessels, because the vessels are described from the owners to us in various ways, where some are more accurate in their description versus others. So for us, not going blindly by the description on paper, actually have prefixing tools to decide which of the 2-3 alternative vessel we fix in for time charter, based on data comparison with sister vessels, etc. It's very important. That's going to help us a lot, saving fuel for long sea passengers. So in short, that's it. It's keep grinding.
Thank you. I wanted to ask maybe a bit of a more sort of philosophical, ideological question, which is, having been to various conferences over the last few years, we seem to be leapfrogging from one geopolitical issue to the next. and so the question bears, is there such a thing as normal anymore, or will we ever return to normal in what is normal, or is there just a wider imperative to build kind of a resilience and adaptability into how we operate? And so I'd be interested to get your views on this question and how you've kind of approached that question in your respective organizations. Maybe if we start at the end with Ed.
That's a good question. I think this year is categorized by basically a lack of volatility in an otherwise normally quite volatile market. But what is interesting being on these panels and talking to people is that there's a balance at the moment between which way the market's going to go in 25 relative to 24, and most of the reasoning behind the balanced opinions is actually geopolitical. And we're all watching Trump, right? If he gets in, are there going to be trade wars, tariff battles, all these sort of trade interruptions? Yesterday, John Michael was talking about pink flamingos, and which being the sort of the events where you suddenly have an amazing market. And we were also talking about sort of the things that can go wrong very dramatically. But what's exciting, and which is why I'm net long but want to keep my debt low, is that we're finally balanced in supply and demand. A small negative shock will create probably a small downside in rates. A small positive shock could create a massive upswing in rates where we're all cashing in and making huge amounts of money. We're at that point, certainly, and I'm generalizing, in the geared segment, I would say there are a lot of companies who are right at the point where they're starting to make a profit. But every extra $1,000, every extra $2,000 a day per ship is going to see a huge surge in profits because it's just all cash at that point. And we're just teetering on the brink of having a fantastic year. And all we need is something small, but we're obviously all watching the US elections. So yes, geopolitics is really what keeps us awake at night.
SY, do you have any views?
I think the normal is no longer is realistic now, but because it's now fundamentally changed after the pandemic, so very difficult to back to normal. Also, it's so many geopolitical issues now with Israel and Hezbollah, and after the USA election, then maybe China-America trade war again, and also South China Sea some problems. So I think it's so many issues about the next year. So we have to keep an eye for market change, something. So I think it's the normal is realistic. Yeah.
Maybe.
I think I have one point from an operator's perspective is that here's where our optionality comes in, right? I mean, we are going to play this really, really hard. We're trying to pull in as much optionality as we have. Utilization is quite high, as Ed is touching upon. So the smallest disruption can make the market fly. So we are ready to capture that by having optionality on our book. And that's one of the big advantages in the operator world. So that is very interesting. We're trying to train our organization to be ready for those spikes. We're trying to have the mentality in the organization to be light-footed, ready, train our people to look for these opportunities. Could be a Panama Canal where suddenly the rerouting of ships and then the canal fee auctions is going up to $1 million over the next 6 months. Then it's coming down again to more or less zero. That's a huge opportunity for an operator. So we have to be ready to capitalize on those.
Any views, Khalid?
No, just a short one on, we take so many things or we presume so many things in this world. Let's just look at 2 geopolitical events that have really disrupted shipping. One is, of course, the Russian war. When Russia went into Ukraine, what did everybody think? 2 weeks and the war will be over. Now we're coming into our 3rd year. When Hamas attacked Israel and shocked them, the whole world thought that, yes, this is a ragtag bunch of guys with flip-flops on their feet and no real equipment, and they'll be slaughtered in a very short time. here we are now approaching the anniversary of the 1 year thing, and it's still going strong. There's nothing slowing down here. So the thing I feel that people are forgetting is that wars have a volition of their own. They have a life of their own. They don't follow your pattern and your presumptions that you have for them. So disruptions can last much longer than you. It's like what one of the famous quips about the freight of the stock market is that the stock markets can remain irrational far longer than you can stay solvent. And it's a similar thing with disruptions in the shipping world. They can last long enough and be strong enough for either for you to make a lot of money or to lose a lot of money. So this is something that I think people are missing out on.
Thank you. I'm getting the signal that we've reached our time, so I might just finish with one sort of magic wish question and ask our panel to maybe keep it to a couple of words. But, you know, as you sit here today looking forward, if I could grant you one magic wish, whether it be in terms of regulation, geopolitical outcome, technological solution that would help you in terms of your decision-making going forward, what would that be as we sit here today? And a couple of words each.
Just one wish. The IMO should have a $100 per ton CO2 tax starting out January next year, and 2 years later double it. If they do that, we'll really have green solutions for shipping. Otherwise, it's just a pipe dream.
Just one word, clarity.
I was going to say get rid of EU ETS, but yeah, I mean, that's the same, yeah.
We are the invest for only conventional fuel engine. So before the regulation or some fuel is dominate is the oil something. So we don't adopt any the additional fuel engine at the moment. Our segment, yes.
I would just say controlled ordering of geared bulkers. We are so close, and the age is getting older, and we can almost see it. And someone's going to go and order 5,000 ships. I know it, but that's my wish.
Anyway, thank you very much, gentlemen, for making the time today and for your insights. I think they've been very helpful and useful for the audience to understand a little bit further about the segment and the world in which you operate. Thank you very much.
Thank you.